Okay, it looks like attendee numbers are stabilizing now. So welcome everybody to TI's Ocean and Air Freight Tracker Outlook webinar for Q3 2025. We're pleased to welcome you all back for another interesting quarter as we look ahead to the end of the year now, really, and the rate outlook for 2026 as well in this particular webinar. As always, the session will last about 35 minutes in terms of the presentation. And we'll be walking through ocean freight first and then looking at the air freight market and providing you with an outlook. At the end, there'll be a Q&A session. So please do feel free to ask any questions that occur to you throughout the webinar using the Q&A app on Zoom. And we'll also be running a couple of polls during the session today. One asking you for your own opinion on ocean freight rate development and the other on air freight rate development. So please do take a look out for those at the end of each section. We'll also be sending out copies of the free report to all participants and registrants afterwards. So if you want to read in more detail, you can do there, and you'll get a copy of the recording too. Now, turning to the actual market conditions we've seen over the last 3 months, well, really, it's a tale of continued disruption and uncertainty. I think that's become the new normal again now, that we're not necessarily looking for an end to the disruption of tariffs and trade changes, but also we're also not looking really for an end to all the disruption in terms of the geopolitical situation, which seems to be continually evolving and not necessarily in a positive direction. So that's very much the normal setting for the market. And actually, we're seeing that pushing the market in different directions over the course of the last few months. It's a really interesting situation. But actually, underneath all of that, we still see a sort of systemic situation of overcapacity and weak demand, which is really, even in spite of everything, defining the market at the moment. And what we then see is these disruptive tariffs coming into effect or changes in geopolitics and minor adjustments trying to deal with that, whether it's stocking in advance of deadlines or and then volumes crashing after that as inventory levels are high. But we always come back to the overall structural situation, and we're going to try and investigate that a bit further today. So I will now introduce our panelists who are going to help us try and navigate all of this. So I am Michael Clover, I'm TI's Head of Commercial Development, and I'll be our host. I'm also joined by Nathaniel Donaldson, who is TI's Data Team Leader. Welcome, Nathan.
Thanks, Michael. Hello, everyone.
And alongside Nathan, we also have Janan Hassan, who is one of our junior economists here and instrumental in putting together the data and analysis for this report every quarter. So welcome, Janan.
Thank you, Michael. Hi, everyone.
Right, so our first content slide now on ocean freight to start with. This chart is basically TI's index looking at ocean freight rate development on a global basis. But obviously in the report you can find the more granular lane by lane analysis as well. This really just gives us an overall picture of what's happened with rates and nicely demonstrates, of course, a huge COVID spike, then the Red Sea disruption, and more recently the tariff spike. But interestingly, things do seem to have returned to the stability before Trump's tariffs and all the disruption caused by that, and much more to that period before Trump took office. So Nathan, could you just explain what's going on here and what we've seen over the last few months?
Yeah, sure. Thanks, Michael. Yeah, so it's a really interesting story. I mean, I think it's a really interesting graph to look at as well. As you mentioned, we can see those spikes and we can see the fall back down. It's a lot of disruption. And really, often if we see it from this level, it's been a lot of volatility in the market. But it appears that it seems to be softening and somewhat. Now, this is a result of pressure in both directions being exerted, both upwards and downwards on rates. But if we look at some actual figures, well, both head haul and back haul ocean freight rates indexes have now fallen to their lowest level in 20 months. So we're definitely in a new phase of the rates here. This is a result of a continued downward trend following the initial downward plunge that we can see in quarter 125. So initial big drop at the start of the year has seen a continued downward trend across most of the lanes. Now, if we look at head hauls, the head haul rates themselves, that index has dropped to 131.8 in August 2025. Now that's an 11.4 point drop versus 3 months prior in May. So that would have been the number that we gave you in the previous webinar. And then year on year, it's down a very big 174.3 points. So we can see the effects of the tariffs, of the uncertainty, and the lower volumes there has managed to pull it down 174.3 points over the course of the year. So we see the overall picture has been quite volatile, but a clear downward trend, pulling rates down across head holidays in 2025.
Yeah, thanks, Nathan. And this graph always makes these changes in the last couple of years seem less significant because of the huge change in COVID. But I think it's important to remember that it's still a huge amount of volatility by historic levels. Not that anyone in the market would need to be told that, of course. So now we're going to try and look at why that's happening, and we're going to look at it from both demand and supply side, but starting with demand and volumes, really. And again, Nathan's going to walk us through the volume trend.
Yeah, of course. So again, an interesting story here, and we see different directions that volumes are heading in, and that we see that actually we've got growth in quarter-on-quarter growth in Europe, Asia Pacific, but a clear drop in North America. If we look at the actual numbers, European volumes, European ports are up 1 point quarter-on-quarter, but they're down 1.4 points year on year. So it's interesting to show that we are seeing some short-term growth in the European market, but we're not necessarily in that situation that we're hoping for of long-term recovery in volumes. Asia Pacific market has been a clear leader in global volume growth, so that's up 3.9 points increase quarter on quarter, and then that's 5.9 points year on year. So a lot of noise from different areas about pessimistic view of volume, especially in North America and Europe, but there is still some strong underlying and structural growth in ocean freight volumes in the Asia Pacific region. North America is down 4 points quarter on quarter, and 0.4 points year on year. So a very clear effect is still continuing to the tariffs, and the uncertainty is still pulling North American volumes down in the short term, and reducing that price pressure for North American rates, and a slight 0.4 point increase year on year. Which is an interesting story, but that also reflects a failure to really recover from lower rates that we've seen over the previous few years in North America, and that's largely affected by the tariffs and the uncertainty. So we have seen an artificial lift in North America that we saw. If you look towards quarter one, we see that it does suggest maybe it was strengthening somewhat, but as Michael mentioned, that's largely effect of shippers aiming to get in before the tariffs. Now we exist with, we've been with the tariffs for a while now, and we see that the larger story is pulling volumes down and having a downward effect in terms of pressure on rates.
Mm. Yes, thanks, Nathan. Very interesting. I mean, I think one other just takeaway on the volume trends is that although when we're looking at month and quarter growth rates and statistics, you see a lot of volatility. Actually, when you look on the year-on-year changes, they're not so broad, or even we're seeing strengthening in volume. So when you look slightly longer term and try and see through the disruption of the tariffs, there's quite a lot of structural solidity there in the numbers, and I think it's always worth bearing in mind when we're considering this and trying to look at the effect of tariffs, as we've been doing an awful lot of work on this year at TI, of course. That underneath all of that noise and disruption, there is a certain degree of structural stability as well, which is a kind of paradoxical situation for the market, really. But actually, Trans-Pacific volumes have been surprisingly stable, really, considering everything and all the disruptions. We're now going to move on to the supply side, though, obviously an important part of the puzzle. And Janan's going to just explain the situation in global capacity. Could you take us through this one, Janan?
Of course. Thank you, Michael. Capacity is an interesting metric this quarter, and it continues to drive both pricing and carrier strategies. If we have a look at month-on-month capacity, we saw a slight increase of 0.4%, moving from about 1.24 million TEUs in July to just under 1.25 million TEUs in August. While the transatlantic and Far East Europe lanes recorded a decline, the Trans-Pacific lane increased. Year on year, capacity is up 5.5% compared with Q2 last year, and it rose from 1.15 million TEUs last year to 1.21 million TEUs in Q2 this year. Quarter on quarter, we've seen actually a small dip of 0.3%. And that's a reminder that capacity growth is uneven and often driven by short-term disruptions rather than huge structural changes. That being said, the global fleet has already hit 3.18 million TEUs, and with an order book equal to more than a quarter of the current fleet, additional supply is almost guaranteed for the upcoming medium to long term. And the order book's equal to about one quarter of that number we already have in the pipeline. And as those ships are delivered over the next 1 to 3 years, they'll add even more capacity to an already oversupplied market.
Yeah, thanks for that. So that really does highlight the sort of state of overcapacity we have in the market. And obviously, as Nathan was explaining, the sort of weak demand, and that's kind of the underlying story that we see. And again, of course, this is the global picture, but in the report, if you subscribe to our trackers service, then you'll be able to see it on a lane by lane basis as well. So that's the supply side in terms of capacity. Well, of course, another key driver is costs, and one of the ways we like to look at that is looking at fuel. And Janan is always watching this for us. So could you take us through the latest on fuel prices, please, Janan?
Of course. So bunker fuel prices in Q3 2025 saw a fall of 14% year on year and 1.3% quarter on quarter. Regionally, the picture varied. The Americas were down almost 20% year on year, and APAC was down almost 13%. Europe, the Middle East, and Africa was down the least by 9%. Overall, the prices remain 37% below their recent peak in 2022. So what's driving this? This weakness is in part of a broader structural decline in fossil fuel demand. Refined fuel consumption has fallen sharply, and Sinopec, for example, reported its lowest profits in 5 years, with diesel demand down 7%, gas down 5%, and jet fuel down 8% in just the first half of 2025. And this just reflects the global pivot towards EVs, alternative energy, and efficiency improvements. Although on the short term, as usual, it looks like geopolitical factors, mainly tensions in the Middle East, will shape price volatility in the coming months, probably towards an upwards pressure on rates.
Thanks, Jan. Yes, interesting, really. Rates are down, but with demand weak, capacity up, and in a state of overcapacity, and fuel prices going down, one might also almost wonder why rates aren't falling even faster. Of course, there's capacity control taking place as well, but interesting mix of factors for us to consider when we look at the outlook, which we will now do. So this is our sentiment index, and just to let you know, this is where we're going to be launching our first poll. So I'm just going to launch the ocean freight poll, and that's asking you what you think is going to happen to rates in the next 3 months. But whilst you're answering that, I will also just take you through what the sentiment tracker of over 1,000 market stakeholders has been doing over the last few months. These graphs can sometimes be a little hard to read, and obviously with the volatility, it's not always exactly clear. Though I think on this one you can clearly see that we're trending towards the increase side of the chart for the next quarter, and have been really over the last few months. But in terms of the actual figures, basically 61% of respondents were expecting some degree of increase in rates over the next quarter. So that's quite a strong signal. The rest is, of course, made up of either there will be no changes, similarly to as you see in the freight rates poll, or that there will be a decrease. But 61% in direction of increase is quite strong. It is interesting as well, just to point out a couple of other things that definitely has changed from a much more extreme expectation of increases 3 months ago. So on that chart, you can see the spike from sort of this Q2, end of Q2, and we were then expecting a much bigger increase over that period, or that's what the respondents were thinking. And now that's moderated substantially, and that kind of goes in line with what we've seen in the real freight rates that have actually happened, where we see rates have been coming down a bit. So thanks everyone for answering. Looks like we've finished now, so I'll end the poll and I'll share the results with you, and we'll see. So, I can see the actually a fair number, in fact, 61%, exactly mirroring what we had on the increase on the poll for the preparation of the report, actually are looking for a slight decrease in rates this quarter, following on, I suppose, from the data. So that's quite interesting to see, and sort of a continuation of the trend from last quarter of expectations for rates declining, or at least leading to decreases. Any quick take on that, Nathan?
Yeah, I think that makes a lot of sense. I think right now we're seeing that volatility is a big factor in the market. We're seeing it. It's a lot more volatile than we've seen. And I think as well, obviously we zoom out a little bit on the rates that we provide here. If you look at the rates that you might see that you can find on the GSCI site, which are provided on a weekly basis, you'll see a bit more volatile story. So it's probably why we're seeing varying stories and contrasting stories here, and probably with quite an unpredictable world. Ask us again in a few weeks or a month, and there might be a different answer. But I do think we can expect some volatility. But overall, the trend has been heading downwards, and so I agree with that. And then the short-term changes could vary somewhat.
Yeah, yeah, all right. Well, let's turn into TI's outlook for the next few months as well, which is a mix really of industry sentiment, our models for rates and our expectations, and analyst opinion as well. So we're going to take a look here, but I'll just explain for those that aren't familiar with these how these work. So basically, at the bottom there, you see TI's directional expectation for rates over the coming quarter. So you see our current expectations are for a continuing decrease, and then expecting a bit of a bounce back into Q4 and peak season before declining again once that probably quite a weak peak season falls off, and then the longer term pretty flat situation really in the ocean freight market. Then if you're looking above at all the different factors which feed into the overall prediction, those arrows indicate actually what the effects of what's happening in each of those metrics or factors, what effect that will have on rate development. So importantly, the arrows don't indicate what's necessarily going to happen to those factors. For instance, like capacity, the arrow there showing down, it's showing the effect that we're expecting that to have on rate development. So more capacity is actually to deflationary rate situations, and that's what the chart shows. So that's the overall picture. But first of all, Nathan, if you could take us through some of the key highlights you think which are really shaping the outlook in terms of demand, and then we'll turn to Janan for the supply side.
Yeah, sure. Thanks, Michael. So I think we have varied story with the consumer confidence. Initially, we see it's having downward pressures. I think there's uncertainty in the market. We're seeing rising unemployment. We've even seen inflation ticked up in some places. So we could expect that to have a negative effect on consumer confidence right now. However, we do see some levels of recovery. We also see that we are widely adjusting to the reality of an unpredictable world. And in quarter four, of course, we've got the peak coming up, so we would expect peak period to add more pressure to rates. Then we head back into quarter one, we see downwards pressure. So generally, we have a varied and changing effect from consumer confidence. If we look at industrial demand, that's largely relates to the interest rates that we've got below there. So we've got lower interest rates, which are encouraging more investment. So, of course, that's a good thing. That might change with inflation changing, but largely that's encouraging higher levels of investment, which can then encourage higher levels of industrial demand. We've also seen that if you zoom in and look at some country level industrial demand figures, that maybe in a few places they've bottomed out, and we do have space for some growth now, which could increase pressure and rates pressure to the ocean freight lanes. And then finally, in inventory levels, now this does vary depending on country and region, but overall, the larger story is that inventory levels have been quite high. We also mentioned the fact that shippers have tried to get in early, tried to get their inventory to the distribution centres earlier. So we don't expect that to be adding much pressure to rates, but then see ourselves in the start of 2026 on the other side of the peak period. We might expect some upward pressure and then more upward pressure further into 2026 on rates on that side.
Thanks, Nathan. Very interesting. And Janan, what about the supply side issues? What's most important when we're thinking about the outlook here?
So looking forward, the market remains oversupplied, and seasonal demand surges are unlikely to absorb the influx of new vessels. Carriers are responding with blank sailings and service suspensions, but the fundamental imbalance between supply and demand persists. The bottom line is that capacity will continue to put downward pressure on rates onto 2026. And while fuel prices softened last quarter due to geopolitical factors, they're not likely to stay on their downwards trend. And overall supplier price power is on the decline.
Brilliant. All right, well, that's the outlook for ocean freight then. So now we're going to turn our attention to the air freight part of the presentation. We'll follow the same pattern as we go through this one, though. And so here we are with the overall global air freight rate index. A more stable picture in recent months, perhaps, than on the ocean freight side. But Nathan, could you just take us through how rates have developed over the last quarter?
Yeah, sure. So, weighted average global air freight rates per kilogram have remained largely flat, as you mentioned, consistent with a general downwards trend throughout 2025. So, seen that throughout 2025, and we definitely seen that continue over the previous quarter. And actually, air freight rates have fallen month on month, 7 out of the 8 months into August 2025. So, a very consistent trend throughout the year. If we look at the actual numbers that we're seeing here, so on a global level, the head haul prices have averaged $2.82 per kilo. That's in August 2025. Well, that's down 4.5% versus 3 months ago, and the figure we would have given you in the last webinar. And it's down 8.3% year on year. So we see that constant fall has facilitated that 8.3% drop. A very similar story on the backhaul. So we see a bit of a smaller fall quarter on quarter. That's down 2% versus the 4.5% on the head haul. And then we see 8.2% year on year. So a very similar story. So in general, we've got softening demand. And then as Dylan will go into detail on the capacity, but this has facilitated a very consistent story of lower rates throughout the year.
Yeah, thanks, Nathan. Yes, and I think perhaps when we look at demand, we can talk about this as well. But obviously, one of the big things this year in air freight, and particularly on the Trans-Pacific lane, has been changes to de minimis rules and the sort of transition from direct shipping e-commerce models on that lane. So perhaps we can see if there's any real evidence of that in the volume data as well. And lots of volatility here in the airport volume index, which takes a look at volume data in major airports around the world. But Nathan, can you try and explain the overall trend here for us, please?
Yeah, sure, thanks. So to start on the global level, we see global volumes rising 4.3 points quarter on quarter, and that's up to 101.4 index points on this chart. And year on year, volumes remain largely flat. That's an increase of just 0.1 points. Fall of 0.1 points year on year. And it's a similar story to what we saw in the ocean parts in terms of volumes. So European volumes, they're up 1.7 points year on year. And they're up 3.8 points quarter on quarter. Asia Pacific volumes also up. Now they're up 1.5 points year on year and a big 6.2 points quarter on quarter. But then if we're looking at North America, the volumes are down 3.2 points year on year. And then quarter on quarter, they are actually up 2.5 points. So all of them grew quarter on quarter. But North America is the only one that is down year on year. And yes, as you mentioned, this is being affected definitely by the de minimis change. We've got evidence that it's encouraging parcels and it's encouraging shipments to be consolidated, which is it's increasing the efficiency and reducing the volumes over to North America. And also we got evidence of that increase. So is it that there's been some more pressure as the de minimis change has been more recent, as customers are adjusting and to the new reality. But yeah, so quarter on quarter we see rises across the board, but North America is clearly down year on year versus the previous.
Brilliant. Thanks, Nathan. And yeah, in the sort of early July data from some of the airports that we've seen, we have seen a bit of a mixed trend, but some improvements in terms of volumes on an airport by airport basis, but obviously a bit early to say just yet. Still quite a lot of data coming out. All right, well, let's move on to supply side and take a look at capacity. Obviously, in ocean freight, we've been talking about um, a state of oversupply really being endemic, but is that the same in air freight? What's the situation in the air freight market, do you know?
The situation is that there was an overall increase in capacity in both cargo ton kilometers, which rose 1.6% year on year, while available cargo ton kilometers were up 2.8% in June this year. And this tells us that supply is expanding faster than demand, a similar story to ocean freight.
Right.
And that's a dynamic that's keeping rates under downwards pressure. On a quarterly basis, we saw cargo ton kilometers average a 4% year-on-year growth, and ACTKs averaged a 4.2% growth. In other words, capacity is still climbing, but at a slower pace than before. And one of the biggest drivers of supply was the resurgence of passenger flights this quarter, which definitely boosted belly hold cargo. In June alone, the belly hold cargo reached its highest level since 2019, up nearly 5% year on year. And that's significant because it reduces the tightness we saw when freighter aircraft were carrying the bulk of global cargo. The backlog on new aircraft deliveries means that this reliance on passenger networks will remain a feature for the foreseeable short to medium term.
Okay, interesting. So, yeah, similar story then, moving into a bit of oversupply over the summer. Okay, and still on the supply side then, what's the situation in fuel for aviation? Can you take us through the trend there, Janan?
Of course. So, for the first time in 3 months, oil prices rose in June, with Brent averaging $71 a barrel. That was up 11% month on month, but still down 13% year on year. And that month ended a long streak of declines. Jet fuel followed a similar pattern, up 9% month on month, but still 12% lower than last year. And the main drivers here were tensions in the Middle East, which raised supply concerns, and US sanctions on Iranian oil, which restricted oil exports, and OPEC implementing output control, with major producers like Saudi and Russia holding back cuts to keep crude over $60 a barrel. Overall, rising jet fuel prices will definitely have an upward pressure on fuel surcharges and possibly an upwards pressure on air freight rates themselves.
Okay, that's one to watch out for then. All right, and we move on to our sentiment index this time for the air freight market. And again, we're going to have our polls. I've just launched that now, and please do give your opinion on your expectations for air freight rates in the coming 3 months. Whilst you're doing that, I'll just talk you through what we've seen in the air freight sentiment index this quarter. So, I mean, overwhelmingly, if you look at a global basis, these three lanes somewhat balance each other out, really. We have Europe to US pretty stable, with the expectations to be quite stable. But Asia to North America, some expectation of a decrease, and Asia to Europe, sorry, an expectation of the increase. And I think that's probably the most interesting story because overall we have 54% of respondents expecting some sort of increase on across all lanes. So it's that's does give us a majority, but it's not a very strong view really. Whereas if we look Asia to Europe, actually 68% of people are expecting an increase of some sort. So certainly on that particular lane, we're expecting an increase. Much more split opinion on the Trans-Pacific lane though. So fairly inconclusive there on the expectations for rate development uh, across the Pacific. So those were the expectations last quarter, but it'd be interesting to see your expectations this time around. And it looks like we've got the majority of our answers in, so I'll end the poll and I'll share the results. And well, it looks like a similarly sort of mixed picture, really. But 45% saying rates will remain stable, 36 increased slightly, and 18 decreased slightly. So very much mixed, but maybe erring slightly more towards stability and a marginal increase after the decreases we've seen over the last few months. Nathan, do you have any quick takes on that?
Yeah, I think that makes a lot of sense. As we understood from Janan's analysis, there is excess capacity. So there's a lot of space. There's not a lot of tightness in the market. There's a lot of space for movement. So we wouldn't expect any severe changes. I think also we probably are at past the point at where we saw a lot of pressure from the tariffs. So it opens us up to some decreases. But I think it's quite open for both, but I think we saw a very stable situation, so it remains probably going to continue to be quite stable. It is still trending downwards, but maybe we've passed the point of the most negative. And as we head into peak, there will be some upward pressure. So some space as we head in towards the end of the year for some slight increases. I don't think there's a lot of tightness in the market to cause significant changes in either way, either direction.
Okay. Yeah. Well, let's look at the outlook as TI has it then as well. So again, this works just like the one that we saw for ocean freight, really. So the line down at the bottom that shows our expectations for quarter-on-quarter rate changes. So we see we're expecting a continued decline in Q3 before a moderate uptick in Q4 with peak season, and then again falling away as we move into 2026. Although we are expecting a better situation for air freight demand and rates as we move into 2026 overall, really. So that's the overall picture. But Nathan, would you like to just highlight a few key demand side factors that are influencing this?
Sure, I think likewise to ocean freight, but this will be kind of a more reactive and shorter term effect because the air freight tends to be more reactive and provide solutions to moving goods internationally. I think consumer confidence is still a bit shaky. It's improved, but it's still a bit shaky. So that could have a downward effect probably until quarter 4 when we have that pressure. You know, people get a lot more confident when it comes to peak times and we're ready to spend and buy for the peak period. So quarter 4, we could expect some upwards pressure and that to drop off again in quarter 1. So similar to the ocean freight and hopefully an improvement later on in 2026. Inventory levels, yes, we don't expect there to be immediate pressure. That we've seen that shippers got their inventory in earlier, so we don't expect that until 2026. And then interest rates should have a positive effect, but that remains uncertain as we head from quarter 4 into 2026 because we've got a lot more noise with inflation. So really similar story to what I mentioned in ocean freight, but probably on a shorter time scale. And the air freight market could be more reactive to those factors that I've mentioned.
Okay, thanks, Nathan. And Janan, on the supply side, what would you like to highlight there?
So looking ahead, the imbalance between supply and demand is expected to continue, much like it might do in the ocean freight market. Load factors are declining, and unless there's a very urgent restocking or stronger than expected peak period in quarter 4, we're gonna stay in an oversupplied environment. Airlines are already trimming schedules and redeploying capacity, but the reality is that freight space will remain abundant. Although the US already saw short-term rate rises from strong summer travel and jet fuel demand peaking and inventories falling. Meanwhile, fuel costs are showing signs of volatility with potential to swing upwards if geopolitical risks intensify.
Okay, well, thanks very much, Janan. And thanks, Nathan and Janan, both for sharing your views today. That's the end of our presentation part of the session today, but now we'll move on to our Q&A session. So please do feel free to ask any questions using the Q&A app on Zoom. I can see we've got a couple of questions in already, but always interesting to hear more from you. So first question though, so maybe this one for you, Nathan. You've mentioned that rates are trending down, but what are some factors which might change this? Can you think of any, Nathan?
Yeah, sure. So I think there's a few factors First of all, is to not forget that mainly supply side shocks can very quickly change the market. And we're not seeing anything right now, but as we've said, and as you'll read in the paper, we recognize that the market is now adjusted to a new normal, new reality. But if we do see some supply side shocks, that can very quickly change the story. With the geopolitical events that we see going on in the world right now. I think the other factor to consider is that there might be somewhat of a quiet recovery in Europe. I know the economies look to be quite questionable, but I do think we are behind the high levels of inflation that we saw, and there is some level of improvement and recovery if we look at the numbers as we've seen, especially in the shorter term. So that could very quickly, over the course of maybe 3 to 6 months, add a lot more pressure to rates, and we could start seeing some increases, especially in Europe, maybe between Europe and the Asia Pacific region, if they both do improve at a similar time and add pressure to the market.
Yeah, yeah, thanks, Nathan. Yeah, I think I like the term quiet recovery. We've definitely seen in some of the data, especially on the manufacturing side, there do seem to be signs of improvement, if not, earth-shattering change from European demand. And certainly speaking to forwarders, carriers, there seems to be a bit of a change in expectation for slight improvement from the European market. So let's hope that that holds true. Um, Okay, and another question. So with so much oversupply in the ocean freight market, and you mentioned that 25% of the um, current fleet is on order, how much power do carriers really have on pricing in such a state of oversupply? Maybe that's one for you, Janan.
Of course. So carriers still have some tools to influence rates, but their power remains limited. The main lever they use is blank sailings.
Hmm.
They deliberately cancel services or suspend loops to take capacity out. And we saw a week in May where nearly 28% of scheduled capacity was blanked, which did help slow the rate declines. But these measures are only temporary. And with a huge order book, a quarter of today's fleet still to be delivered, new
Mm.
ships will keep flooding in, and that oversupply will push rates down. So while alliances can exercise some discipline and create some artificial stability, the bigger picture is that supply is outgrowing demand, and which shifts the balance of power away from suppliers. Hopefully, the quiet recovery will continue, and that might buoy rates to a stable level.
Yeah, yeah, okay. Um, So another question just came in. What considerations should be considered due to Golden Week and Chinese New Year for both air and ocean freight? Yeah, interesting question always. Maybe that's something to think about from a capacity point of view, and supply side. So I don't know, Janan, if you've got any thoughts about that in terms of effect on capacity and booking a capacity then.
Of course. So these two holidays always create volatility because they shut down large parts of Chinese manufacturing and logistics.
Hmm.
Uh, it's less about avoiding disruption and more about timing and aligning the schedule with the surge and drop pattern. Um, Before the holidays, exporters usually rush to move the cargo and create the demand spike, and we usually see higher rates and tighter capacity and more blank sailings. But during or right after, production slows down and demand just falls off, and that means that rates will dip. So the key here is timing, really.
Yeah. And actually, I think that probably follows on to the next question. Always a tricky one, this one. But what would you suggest is a sensible rates validity agreement period? So sort of fixing rates for air and ocean based on the information shared today. Always difficult, I think, because of course we're uh, predicting quite a lot of volatility in the rates coming up as continuing sort of this downward trend for now and then picking up a bit over the Q4 period. So tricky to say, of course. I don't know, Nathan, do you have any thoughts on that? How long is the current state or rates, currently likely to hold for?
Yeah. So, I mean, really hard. It depends which becomes the dominant factor, on rates pressure. I would probably say if we're looking at the ocean freight market, we can expect, I mean, it depends on the strength of peak. If it does start to look like we might have a strong peak period, and this evidence suggests that, consumers are going to spend regardless of what money is available because they want to celebrate, then we might see some upward pressure on the ocean freight market soon, as shippers have to start importing and bringing in goods. So really, that would be before the start of quarter four. The air freight market is likely going to be, it's going to react. Um, it's more of a shorter term solution. So we see the peak pressure closer to the end of the year. So then there's a bit more time and space before you see that rise in rates pressure on peak. So I would say probably sooner for the ocean freight market, but then there's more time for the air freight market. There's a lot more space and capacity in the market as well. But then as you head into December, for sure, you're going to start seeing the effective peak, probably in the end of November. But that's probably going to be more October maybe for the ocean freight market.
Thanks, Nathan. Yes, so of course a key consideration there as well is the rate situation going to improve or not as well? Always a very difficult question to answer. But of course that's what we're attempting to tackle here with the quarterly trackers to give you a sense of the outlook and look ahead to the next quarter and the next year ahead for exactly the kind of decisions. So if you do want to look into that in more detail, I encourage you to get in touch with us about the logistics trackers, the quarterly reports, and the data dashboards that sit behind them. There's a lot more detail there on all of those kind of questions and on rate development. So please do get in touch with us if that's of interest to you. So thank you very much, everybody, for joining the session this afternoon. It's good to have you on for another quarter. It's been another really interesting period in both air and ocean freight, and I'm sure it will continue to be so. So we look forward to welcoming you back for next quarter. In the meantime, thank you very much to Nathan and Janan for sharing your views, and thanks once again for joining us. We'll see you next time.